but from what I've seen, Phil is pretty good at these. So before I start, just a quick introduction to Phil Andronico. So Phil is part of our investment team and investment committee that sits over in Sydney. I'm sure a lot of you have already met Phil and have heard one of his presentations in the past. So the session today is being recorded. So if anyone wants to revisit the session or wants to go over everything again or send it out to someone else, we will be sending the link out to everyone via our communications. We also have the ability to ask some questions. So if something does pop up and you find it interesting or you would like to know a little bit more about it, please type in your question and Phil will address those either as we're going or towards the end. We'll also be running a quick poll. So we'll be doing the poll initially to get some sort of response and understanding about what your thoughts are about the current market, and then we'll run through Phil's session and we'll run that poll again at the end just to see if that's changed your views in any way. So yeah, that's everything from our side. I'll hand over to Phil.
Hi everyone, welcome to today. Thank you for joining us. As Shane's alluded to, we'll sort of start with a poll, but before we kick off, we'll start with a disclaimer first. Just everything today is sort of general advice. So, before utilising any of this information, be sure to consult your relevant advisor. So we'll sort of start kicking off. We're just going to have a short poll here. So as Shane alluded to, there's question. You can do a Q&A or chat on the application, and on the poll that I'm about to click on now, you can just utilise, it's a multiple choice question, and we can sort of just see what the responses are going to be. What I might do is just share my screen while that's happening. So hopefully you've should be able to see my screen now. Shane, is that right?
Yep, you can see.
Okay. So there's a poll that should have popped up on your screen, hopefully, and you can just start submitting your responses. So the question is, do you think we are likely to see an economic recovery in a V-shape, U-shape, or more of a prolonged recovery? V-shape, it'll all be back to normal by the end of the year. U-shape, maybe back to normal by the end of next year, or actually this is going to take a while for all the implications to work out. And we're really talking more about the economics rather than, say, the share market. They can be a little bit detached, but they're kind of related, I guess. So I think that's kind of so far the majority of people who have responded, and it's sort of showing that very few people think there's going to be a V-shaped recovery, and about 2/3 believe a U-shape, and about 1/3 of people thinking actually this may take multiple years to sort of recover from where we are. So what we're going to do now is we'll work through the sort of presentation, and then maybe at the end we'll ask the question and just see if there's anything interesting in terms of changes in people's thoughts. And for what it's worth, I was just curious myself because I ran this poll about a month ago, and most respondents probably answered U-shape about 2/3 and about 1/3, and the rest split between the other two answers. So nothing's changed over a month, despite the fact that we've had a bit of a rally in market. So sentiment sort of remains about the same. All right, we'll sort of start talking. What we're going to cover today is a little bit of just an opening, and then we'll sort of talk about what the impacts on the market and economy have been thus far, as best as we can describe them. Then what we're going to do is drill into equity markets a little bit, and then we'll sort of finish a little bit with what we've been doing, where to from here, and how we're sort of seeing the forward-looking aspect of in the environment. So, I'm sure everyone's sort of kind of sick of being bombarded with news lately, and if it's not one thing, it's another. So, we had the coronavirus, we had a bit of an oil crash crisis, and now we've got sort of protests all over the US, a lot of social unrest, and despite all of this, markets have sort of corrected and then started to sort of retrace back upwards quite quickly, and then you have a lot of sort of experts, I guess, across the press sort of talking about this doesn't make any sense, or actually everything's going to go back to normal quite quickly. So there's a lot of conflicting views out there. So it can get a bit noisy in terms of trying to determine what are you meant to do with all of this information, particularly when you sort of see quite polarizing views out there. What we sort of think about is just, maybe take a step back a little bit, and what lessons can we learn from, say, a chess grandmaster? And, I think this sort of quote sums it up, which is a lack of patience is probably the most common reason for losing a game or drawing games that should have been won. Ultimately, what we're really thinking about here is what can we do in the here and now that positions us better for the long term? Don't get too hung up about markets fluctuating quite severely in the last few months. Really, either that presents yourself with an opportunity, or if you feel that actually it's bottomed and we've missed some of the rally, that doesn't really matter either, because actually there's still lots of opportunities out there. So, depending on which way you feel, whether you think actually things might get worse or actually things have gotten better quicker than I expected, really, we've got to remember this is a long-term plan that we're implementing here, and there's still relative value out there to be seen. So I'm going to sort of drill into the impacts of on the market. What have been driving markets? Well, the obvious thing has been the impact of the coronavirus, or COVID-19. Then what's sort of driven that since then is central bank government policy response. The other factors are what's growth going to look like, or potentially lack of growth coming out of this downturn. And then on top of that, you've had an oil oversupply or lack of demand in the market. Tensions with China have continued, both on sort of the front around who's to blame for the virus and what implications that might have for trade, particularly between the two largest economies being the US and China. And then more recently, we've started to see things such as political unrest, which surprisingly hasn't really had much of a bearing on markets to date. Whether it might have further implications for economies like the US longer term remain to be seen. But those are really the things that are driving the markets. And what's been the impact thus far? So excuse the techie black looking Bloomberg charts here. It's just easier for me to get the data from here. But if you actually look what's happened since the start of the year till about yesterday, we had that sort of severe correction of about 35%. Now, it's important to note these are in local currency terms, so it doesn't account for the exchange rate difference between other currencies, be it the US dollar and Australia, for instance. So this is what happens to a US investor if you were in US dollars. And, pretty much most markets fell sort of around 35 to 30%. And, since then have started to sort of retrace. Interestingly, China being sort of the epicenter of the start of the coronavirus actually didn't fare that badly. And maybe that's because they were in earlier and out earlier. And since then you've seen sort of that retracement up, whereas things like Australia and Europe were kind of lagging. And then only in the last sort of week or so has that sort of started to retrace back upwards. Now, this is in local currency terms. What I'm going to flick onto now is a chart in Aussie dollar terms, because really this is what, as an Australian investor, you would have experienced had you invested in overseas equities. And you can see there that in Aussie dollar terms, the correction for countries such as the US, which is in red, or Japan, or even Hong Kong and China, for instance, the actual drawdown wasn't as bad. And the reason for that was that you basically had the currency fall at the same time. So basically that acts as a diversification benefit when you're invested globally. So you've had your actual experience, if you've been in a diversified portfolio, hasn't been anywhere near as bad as the sort of 30% headline rates you might have seen happened in the Aussie market, or even markets more broadly, because you've had sort of diversification benefits in there. One, across different regions. Two, having the currency effect in there. And really, in Aussie dollar terms, it's really just Australia and Europe, which are the laggards, and some parts of Asia where Hong Kong's still having issues with social unrest there. And then, in some cases, some of those global regions have actually kind of almost made it back to where they were at the start of the year. Mind you, we did have a little bit of a rally at the start of the year, if you recall. So, from a diversified portfolio perspective, things aren't as bad as what they may seem when you're sort of reading the press and things like that. Now, what's sort of driven some of what I'm going to look at here is comparing this sort of crisis to other corrections we've experienced in the more recent past. So, if you look at sort of the severity and the speed of the correction, it was one of the fastest, if not the fastest, correction markets have ever experienced. And I'm using US data here because it tends to have the longest history, and it is the most dominant market globally. But you've seen there that the correction was on par with the 1987 crash, which was previously one of the quickest corrections. And, then you've got sort of the GFC being the gray line where, markets actually fell in the US from peak to trough 50%. And, the tech crash, similarly, you had sort of 50% falls. But what's, different is the speed at which this occurred. Usually these corrections were much more longer, drawn out corrections. The only one where you saw a sort of correction, then a sort of immediate beginning of a retracement was the 87 crash. But even that took about 2 to 3 years to get back to previous peaks. And what's quite unique about this one is, one, the speed of it, but even this is what's caught a lot of market participants by surprise, is the speed at which this recoveries occurred. And particularly given that these are US equities, and the US market, you've got the US, the country of the US is actually still going through probably the worst of the coronavirus. It's been the worst hit by the coronavirus, and yet it's the market that's sort of done this the most, whereas the other markets are still kind of lagged a little bit. So it has caught people by surprise a little bit. But, I guess the question mark we'll have to be asking ourselves, and as we sort of progress through the presentation, is, how sustainable is that? Is this sort of a little bit of a bounce, which you do tend to see sometimes during corrections where, if you look at the sort of tech correction, we had that fall, then it recovered, and then it fell. Even the GFC had a few sort of rallies and then further corrections. So I guess the question mark is, will that be the case? And really what we wanted to understand is what's driven this. So the answer is kind of on the next page, is basically it's been central bank and government policy response. Unlike the GFC, where policy response sort of came about 12 to 18 months later, the policy response this time has been much quicker and much larger. If you compare what most, and there's been two levels of policy response. One, what's called monetary stimulus, which is basically central banks or reserve banks, so Reserve Bank of Australia, US Federal Reserve, as these two examples, coming to the fore in terms of lowering interest rates quickly and aggressively, and then also targeting longer dated interest rates. So not just saying we're going to lower the cash rate, but we're actually going to put mechanisms in place by buying bonds in the market to push down 2, 3, 4, 5 year bond yields. And basically what that's sort of telling the market is that, say for instance in Australia, the RBA has been very explicit about it, saying we are going to target 3-year bonds at 25.25%, which is basically saying for the next 3 years, interest rates are going to stay at their lower band. Then other things that they've put in place is making sure that there's been enough liquidity in the system, making sure the banks are well supported, because the last thing they wanted on top of a health crisis was another financial crisis. So, this didn't start as a financial crisis, but they didn't want it to morph into one. So they did everything to make sure they supported the banking system as much as possible. And the reason for that is you've got to think of the banking system as the plumbing of the economy. It keeps everything flowing, it keeps trade going, and you need to make sure that it's liquid. The second round of stimulus was fiscal stimulus, so effectively government spending. This is governments either taking on debt or utilising money from the Federal Reserve, effectively kind of money printing, to provide fiscal stimulus, government spending into the economy. In Australia, you saw it in the things such as JobKeeper, JobSeeker, cash flow boost for small companies. And, it was mostly directed at individuals and businesses, which is kind of where you want it to be. And then, there's secondary things such as lending support, backing business investment, etc. In the US, it was an initial $2 trillion relief. To put that in context, the total recovery package during the GFC was $900 billion. So this was more than twice the size of the economic stimulus provided during the GFC, and within the month of the crisis, as opposed to 12 to 18 months of the crisis. Most of that was targeted towards boosting unemployment benefits, direct cash stimuluses to households, and loans to small businesses and states. They didn't then announce a couple of additional packages, which took the total stimulus to around 13% of GDP. In Australia, it was roughly around a similar magnitude. So really, that kind of explains why we saw that quick, sharp turnaround when all of these measures were announced. And in a couple of weeks, you were sort of already part way back. And then since then, markets have kind of grinded upwards as their expectations of, lockdowns ease. So, from a central bank policy perspective, from a policy response perspective, the sort of four main stages that you can implement. One is provide liquidity to keep the financial system solvent. So this is sort of really targeted at the banks. That's been largely done. Most central banks have been sort of making sure that the banking system's supported. The second stage of that policy response is actually getting that money out of the banks and lending into the economy. This is in motion. Governments have put incentives in this for this to occur, but it's not necessarily perfect. Like all of these policy responses, they've been done in a hurry, so then they might not be perfect, but they were kind of needed quickly. So you could either do it properly and take longer, or you could do it not so properly, but get it in place quite quickly. And that's what most governments have done. So from that perspective, getting money from the banking system into the real economy is the next challenge in terms of stage two. That's probably a little bit difficult because, corporate balance sheets are still deteriorating. People aren't quite back to work. And, you might not see that until it all comes back. The second challenge was that it might not have gone to all the correct places, particularly in the US. Large companies benefited from this, but really what they've done is just use that to shore up the balance sheet, keep the cash in case they need it, and haven't actually spent it. So the next thing is actually trying to get that money moving, and that's called the velocity of money, and that's how you got your sort of multiplier effects through the economy. That is sort of in motion, but not progressing as well as it could. The third sort of step is you want to make sure that, given the US is the sort of reserve currency, that there is enough liquidity flowing through to foreign markets and in particular emerging markets. A lot of emerging economies are still reliant on foreign investment to fund their economies, and unless you want an emerging markets crisis, you need to make sure that there's enough liquidity provided, not just within large economies such as the US, but more broadly across the globe. And that has been sort of put in place. Obviously, it may be challenged by things such as the US-China trade war, and then more longer term, what will be investors' appetite for taking on risk globally and into emerging markets. But early signs are indicative that that's occurring. And then the fourth one is what may prove to be controversial in time is fiscal stimulus. So it sort of started with a bang in terms of all that sort of money, cash in the hands of consumers. It's not been perfect. Maybe some people got JobKeeper and others didn't, things like that. Longer term though, the real question will be is how do we pay for all of this? So government debt will probably go up, particularly in Australia. In the US, it is almost effectively money printing. It'll be supported by the Fed providing liquidity into the system. This may then lead to inflation risk. So, I think in the here and now, people will probably be grateful for any stimulus that comes. However, longer term, it may prove to be politically difficult as, people start to question how do we pay for all of this in the long run. I'm not going to dwell on COVID too much because I'm pretty sure most of you listeners are probably sick of hearing about it, reading about it. So I've only dedicated one slide to this, but we'll just sort of touch on it quickly. If you look globally, effectively where it was the biggest issue first was countries such as, countries within Europe, particularly places like Italy. And so far the trend has been going in the right way. And this is probably what's giving some confidence to markets more broadly, is that actually this thing can be gotten on top of, and actually we can move past it. There obviously are fears of a second wave as restrictions ease. And when we talk about second waves, it might not be necessarily another wave as high as this, but it only needs to be half as high for it to cause sort of some disruption and potential, retracement of lockdowns, things like that. So, there are concerns around there of a resurgence or a second wave in particularly as certain economies unwind. In the US, it's trending the right way, but obviously they haven't probably locked down as aggressively, and they've still got a large number of cases. The US is still adding 20 to 30,000 cases a day, and eventually that'll peter out. But it hasn't been as sort of the peak and then the fall as sharply as it hasn't had that bell curve effect that say places like Italy have had, or even Australia where we've been quite lucky. It's still taking some time. Where it really is starting to take off is EM countries are still on the rise. You can see Brazil there is really kind of only getting sort of starting out where the US was at its peak. So, you know, those are the concerns. And what that might mean more globally is that, you know, countries might unlock within countries, but might not mean global travel, et cetera, resumes for quite a while, because there will be concern for countries such as Australia, et cetera, that have done pretty well of inviting cases from certain countries. So you might start to see bubbles form where, you know, we can travel to New Zealand, and then that sort of expands out to certain countries that have maintained low cases, et cetera. But, you know, there are fears that secondary waves may occur as, you know, you've seen outbreaks of clusters in Singapore, Japan, South Korea, who have done almost as good a job as Australia in terms of maintaining a low number of cases. So I think probably what the summation of this is that some of the panic has been taken out by the headline numbers we're seeing from the coronavirus and the impact it may have on markets. And as countries are starting to remove some lockdown restrictions, you know, that's sort of provided confidence in the market that, you know, things will get back to normal quite quickly. However, that might not necessarily be the case, because, you know, there is talk this could be a seasonal thing. You know, I'm sure a vaccine will be available at some point, but maybe it'll take longer than expected. So, you know, there may be further volatility that comes from this, but I think the greatest panic's been sort of taken out of the market on that front. What impact has it on the Australian economy? So, you know, these are just sort of some early signs available from Ilion and Alpha Beta. You know, during the crisis, you saw spending fall quite severely, about 20 to 30%. Overall spending fell about 20%, but non-discretionary spending, so non-essential items, you know, fell quite aggressively, about 30%. And then obviously you had all the panic buying during the crisis that pushed up essential spending. And, you know, that sort of started to normalize. It's sort of about 4 to 5% down now. But as you had stimulus come through, you know, sort of people get used to sort of the environment they're in, things started to sort of return to normal there. On the other side, when you look at credit applications, so this is people taking out credit cards, mortgages, any other sort of personal loan or any other sort of credit. And, you know, you've got to remember that credit drives the economy. As people take on loans, they spend more. And you've actually really seen quite a severe drop in credit growth there, and it hasn't really started to recover yet. You know, probably not many people, you know, maybe people are willing to spend a little bit, go to Bunnings, you know, renovate the house while they're at home, but probably not many people are willing to take on debt given the uncertainty in the environment. And that's sort of what you're sort of seeing. Where did most of the money spending come and go from? Well, no surprise, sectors that have been directly impacted by the coronavirus, such as travel, pubs, gyms, etc. So a large fall in volume and sales, whereas, you know, where you saw the largest increases were in things such as food delivery, furniture, and probably more concerning alcohol, tobacco, and gaming. So, you know, you've seen that sort of large divergence. There will be some winners and losers from the impact the coronavirus has had. And, you know, maybe as things return to normal, these things start to recover and that sort of thing starts to abate. And, you know, really it's been a switch in consumption from one like thing to another like thing to some degree. Similarly, in the US, you've seen sort of similar type of data occur. Auto sales fell quite aggressively. Business investment was already weak and was struggling and fell further. And then similarly, you know, you've seen consumer takeaway spending increase, whereas consumption at restaurants, bars, and hotels decreased. In the US, you've seen initial jobless claims surpass even levels that were seen during the Depression, and you've seen the unemployment rate spike to about 14% from a historical low of around 3%. So the question will be: is how temporary is this? Does it go back to half what it was once restrictions ease, or does it stay permanently higher? I guess the next few months will determine that. I'll touch on oil a little bit just because it was sort of relevant a few weeks ago. You know, you saw a massive collapse in the oil price. So on top of what was effectively a demand shock, you know, basically everyone staying at home, no air travel, etc., had a massive demand shock on oil producers in the sense that there just wasn't enough demand there. And, you know, it's not easy to just turn off a producing well. So, you know, you started to see oversupply that impacted the price. And then you basically saw OPEC plus, which is OPEC and Russia, fall out and sort of start a price war amidst all of that. And that's where you saw the oil price correct quite aggressively. And then it sort of retraced a bit. So the question you might have here is saying, well, it's still at all-time lows. What's that mean for oil stocks, things like that? Could there be opportunities there if this normalizes? Yes, potentially. I guess the question you've just got to remind yourself is that as all of this oversupply has occurred, they've pretty much run out of storage, not enough place to store the oil. So, really what that could mean is it's really a 12 to 18 months, almost 2-year workout for oil as they work through those inventories and things go back to normal. So if you were to sort of take a very contrarian 2 to 3 year view, then maybe there's opportunities in that space. If you're thinking it's something in the short term, it might take a little while to wear through. Certainly from our perspective, any oil stocks such as Woodside that we held in the portfolio, we certainly weren't selling at the bottom. Our view was that at some point this normalizes, and really we're just, we'd want to hold something like a Woodside on a long-term view. So we certainly wouldn't be selling anything at the bottom. And in some cases we even topped up. But yeah, if you're looking at that space, it's probably a little bit of a longer term view. In terms of the economic impact, the US had its GDP data come out for March. Now, the way they quote it is quarterly data but annualized. So you can divide that by 4 to get the actual quarter effect, which would be about minus 1.2. But they sort of annualize, do it on an annual basis. So effectively, that's equivalent to a 4.8% drop in GDP for March. And that's sort of the biggest drop that we've seen since 2008. Now, it's also important to remember that this is really only reflective of, the March quarter is January, February, March. Most developed economies outside of Asia and Europe really only began their lockdowns during February/March. So this kind of only represents about a month of lockdown. And, the real question will be, what's the June quarter look like? Because effectively you've had almost a full 3 months of severe restrictions. So, analysts try and take a prediction on this. So this was the quarter number, which was, most analysts were predicting minus 4.3. Mind you, in April, they thought it was going to be minus 3. So it surprised them. But for the next quarter, they're sort of predicting that there'll be a 33% drop in GDP. Now, if you want to do that on a quarterly basis, divide it by 4. So you get about an 8 to 9% correction there in terms of GDP. And then the view is that, this is a survey of 60 or 70 analysts across the market who say, what do you think GDP is going to be in quarter 1, quarter 2, quarter 3, etc. So it's the average of everyone's expectations. So, there's expectation that you'll see a much more severe drop in Q2, followed by a bit of a recovery off the bottom. And then it takes about a year for us to get back to sort of trend growth rates of about 3%. So that's kind of what the market's predicting, is that Q2 is going to be the most severe. If we look at Australia, we saw our GDP came out yesterday. It was down minus 0.3% for the quarter. So Australia quote it differently. We just do it as a quarterly number. So it's down minus 0.3%. The technical definition of a recession is 2 negative quarters in a row. So we have had negative quarters, during the GFC, but it was only 1 negative quarter. So we never technically went into a recession here nor here. But the expectation is that the next quarter will be negative, and therefore we'll hit our technical recession, which will be the first one since 1990, where we hit about minus 1% negative GDP for the year. So where are Australian analysts predicting the GDP number falls to? So they basically thought it was going to be about a minus 0.7 for the quarter. It actually probably surprised because it was only minus 0.3. But then the next quarter, they're sort of predicting around about an 8% fall. And then we don't have as sharp a recovery. It's sort of a more slow grind out recovery before we get back to trend numbers. So there's the sort of, general consensus is that next quarter is going to be pretty hard hit. And, equivalent amount to the US, but with a much slower recovery is expected from most analysts or economists in the Australian market. What we're going to drill down now to is, we've sort of touched on the economy, but what we want to look at now is, what does that mean for equity markets? Because equity markets try to predict forward. They try to think about, well, that's what the economy is doing, but what's the economy going to look like in a year or 2 years' time? And that's what we'll base our assumptions on, and that's what drives equity markets. So really what we want to do now is just dive into how we're looking at it, and this may form some of your own views around what that means for you and your portfolios, or how comfortable in terms of taking risk you are in that regard. But if we just look at, we'll look at the Australian market and the US equity market, just because they're most relevant either globally or relevant to Australian investors. If you look at the Australian equity market and you look back to the GFC, we hit our peak prior to the GFC in sort of 2007, 2008. It took us that entire 10 years. We only just got back there recently in price terms. So this is just ignoring dividends, just looking at the price of the stock market. So it took us 10 years to recover. If you actually look at the US market, it peaked in 2008. It fell just as much in the GFC, but it recovered much quickly. By about mid 2013, it reached its previous peak and then continued upwards. Hence why the US has been one of the best markets to be invested in for the last 4 or 5 years. Now, why is that? Why did we take 10 years to get back to our previous peak and the US only took here and then kept going? Well, the answer is in what happened to the earnings of the companies within the market. So if you look at the earnings per share for Australia, over a 50 or 70 year time frame, which we've got data for, earnings in Australia grew at about 5% per annum per year in Australia. So earnings per share grew about 5% plus per annum. Now, that's what it would look like in a straight line. This is what the actual earnings per share number looks like in terms of what the actual numbers were. So obviously we that growth all came during the mining boom. So we had a big sort of, we were sort of a bit of a laggard, and actually from the 90s, 89, 90 recession, there was sort of, earnings were actually flat. They didn't recover until about 2000. And then 2000 came because, we didn't have any tech in our market, et cetera. So we didn't have a tech boom like the US did. And earnings really only took off during the mining boom. Then the GFC hit, you have a few write-offs, and then they recover quickly. And then it's taken a while for them to get back even close to where they were during the GFC. So you can see here that, the share price kind of fell with earnings, and then it sort of recovered and was a bit zigzaggy as earnings kind of came through. And that's kind of what's happened in Australia. So earnings were already coming off a little bit before the crisis. They were about here from this peak that we saw early in last year. So the question you've got to ask yourself now is, where do you think earnings go from here? So if you think it's going to be a sharp V-shaped recovery, you're going to expect earnings fall quite severely, but it's okay, we'll look through it and they'll get back quite quickly. Or you think actually maybe earnings won't fall that much, they'll only fall a little bit and they'll get back to where they were. Another scenario could be the U-shape, they fall and it takes a while to get back where they are. Maybe something that sort of happened like after the GFC, where they recovered a bit quickly and then they took a little while to get back to previous peaks. Maybe it's a shallower but a bit of a U, or maybe it's a bit more like the GFC type scenario where it falls and then we go back up again, and then maybe companies can't grow as strongly, so earnings fall again. So you've got to think about what these scenarios might look like, and that'll give you a sense of whether you think the Australian market looks cheap, fair value, a good buying opportunity or not. It really is about where we think earnings might be going as to what is the relevant price we pay for equities. So to give you an indication of where the market has already made assumptions, the market has already assumed earnings will fall to about here. So that's already in the assumptions for next year's earnings. The market's saying it's going to go from about here to there, right? That's the summation of all the analysts in the market looking at every stock, coming up with a number of where they think earnings are going to be, and then aggregating it up. So effectively, the market's already pricing this in. And you can see that in sorry, that's the Aussie market. Just for completeness sake, this is the earnings profile of the US. So you can see there, that was the GFC peak, the correction in earnings, and then the recovery, and then earnings grew from there, and hence why their market kept going up and ours took 10 years to recover. So, really the earnings do dictate where the stock prices go over the long run. Maybe in the short run, month to month, it's a bit more volatile than that, but in the long run, share prices follow earnings growth. So what's that mean for valuations? So we're going to get a bit technical here, but if you look at the chart on the left here, which is 1 year forward PE, prior to the crisis, Aussie equities on a forward year basis. So just looking at, so there's two types of PEs. You can look at trailing earnings, which is just looking at last year earnings and the price divided by that last year earnings. But really the market's concerned about what the earnings is going to be this year. really when you're buying a company, you don't care about what it earned. You care about what it's going to earn. So really, most of the time you look at forward PEs. And what basically it was saying before the crisis was that the forward PE was trading on about 17 times. Then the crisis occurs, the price falls, but the earnings don't change. You get PE back to normal, and then earnings fall, and then the price recovers. And I've tried to sort of articulate that down the bottom. These aren't actual numbers. These are just stylized numbers to get you the concept. But effectively in February, if the market was trading at about 6,000, a price of 6,000, and you had earnings of 350, that would have given you a price to earnings ratio of 17 times, which is effectively that dot there. Then what happens is, because analysts have to go through all their numbers, all their assumptions, it doesn't happen. The price can correct quickly, but the analysts take time to go and do all their grunt work to figure out what the earnings are going to be after an event like this occurs. So there's a little bit of a mismatch in the data for a very short period of time, because the share prices fall from 6,000 to 5,000, but analysts haven't updated their earnings yet. So you get a false PE of 14 times, which says, oh, well, it's only 14 times. That's cheap. And that still could be a buy signal. And then what happens is, what we've seen a bit of a recovery, but analysts have now had time to go and readjust their earnings for next year and say, oh, well, actually, we think it's going to be 280. And now it's 21 times. And that's what you've seen happen there. So on one hand, you could look at 1 year forward PE and go, well, wait a minute, things got cheap and then got really expensive, even though the price isn't back to where it was prior to the crisis. And that's because the earnings assumptions have changed. Now, what the challenge at the moment is that that's just looking at 1 year. If you think this is just a 1 year event and actually earnings are going to be impacted for the 1 year, you write off 2020, but by 2021, earnings are going to go back to 350, then the PE would be lower. It would get back to 17 times and it would be back about here. So really what's happening in the market at the moment is most market participants or fund managers and things like that are doing what they say is looking across the valley, which is basically saying, just look across the earnings valley. It's going to drop. Don't worry about it. What's it going to be in 2 years' time now? So you're almost going back, not going 1 year forward now. Now you're having to look 2 years forward to determine whether you think you should be buying equities today, which obviously adds a bit more timing risk to it, right? So the point being here is that that's one way of looking at things, and that explains why you've seen the price hasn't fully recovered to sort of 7,000, but the PE's gone up, is because the earnings number assumption has changed. If you think 2022 numbers are going to be better than 280 and more like this, then actually markets don't look too bad again. And effectively what the chart on the right tries to do is take that and smooth it out. So rather than just looking at 1 year numbers, it looks at a 10-year average and says what's earnings over 10 years, divide that by 10 years, and that'll give you a smoothed out PE. And effectively that's what a long-term PE does. And on that basis, you could argue Australia looks sort of a little bit expensive or fair value when compared to historical averages, but definitely not as expensive as it was prior to the crisis. So from our perspective, we probably look at Aussie equities and say there was a very, very short window where you could have argued it was cheaper than it was, but it was by no means cheap or as cheap as it was during the GFC. It was about fair value at best. And then it's probably a little bit more above, it's a bit above fair value now if you assume earnings smooth out over 2 years. The US, on the other hand, is a little bit different because it was expensive before the crisis, and by the same dynamic, it's now trading on very high PEs. It's recovered the most in terms of global equities. It's pretty much almost back to its previous peak. And even on a long-term PE basis, it still looks expensive. So portfolio implications for us mean is that we'll probably, we've been underweight the US for a fair while. We'll probably remain underweight, but we'll neutralize any underweight to the Aussie market and probably be a little bit more closer to more fully invested in the Aussie market, still remain underweight the US. And then if you look regionally, some other regions are in a similar situation to Australia where they look about fair value, and that's highlighted in this chart here. So looking at those longer term PEs, the US still looks expensive relative to its long-term average. Europe looks about fair value, Australia about fair value, and emerging markets looks cheap. So we'll touch a little bit on those later, but effectively what we're sort of looking at is there's still opportunities out there globally. US maybe isn't the place for them though. So where to from here, and we'll touch on the value advice. So obviously, you know, it's been quite a turbulent couple of few months. You know, there was probably the year started off reasonably well. Markets were trending upwards, and then the crisis hit. And then, you know, we tend to go through, you know, investors tend to go through these emotions, you know, where the correction happens, there's a little bit of capitulation, selling out of the bottom, potentially. And then, you know, as things start to maybe turn out not so bad, you know, hope, relief, optimism come in. And, you know, that's the cycle of emotions that investors go through. And, you know, I guess part of what we try to challenge ourselves to do is not fall into the trap of these behavioral biases, and sort of look at the data that we've looked at throughout the presentation to kind of give us a bit of an anchor, a bit of a guide as to how we should actually be positioning portfolios. And obviously, you know, in conjunction with your advisors, they're sort of there to sort of help manage through these emotions that we would tend to go through market corrections such as the ones we've experienced. In terms of what we're sort of looking at in a valuation perspective, and, you know, looking at those numbers that we went through in terms of the PE charts, we try to plot this on an expected return and a risk chart. So this is a forward-looking view of where we think expected returns might be. And, you know, for a long while, we've been saying, look, you know, if you took a very long-term view, being invested in equities still was probably going to reward you more than being in bonds. So you didn't want to sort of necessarily make a hero call and be out of equities in any large way, but they did look a little bit expensive for what they were. Obviously, you've had the correction now, so it's made these things a little bit more attractive relative to risk and relative to defensive assets. So, you know, if you were to park your money in cash for the long run, you know, chances are you're not going to really earn a very good return, and in fact, inflation is probably going to eat away at your capital. Whereas your only real chance of achieving a return above inflation, so that you you preserve your purchasing power, is to take on some risk. And what we try to do is mitigate where we can the level of risk, and take opportunities where we can. So one of those opportunities was in an asset class that we'll touch on in a little bit later, called high yield fixed interest, which would be plotted about here in a more detailed chart. But we'll touch on that a little bit later. In the next slide, I believe. Yes. So what have we been doing in the portfolios over the last few months? Well, in early March, when it was sort of apparent that the coronavirus was having a broader impact on more developed economies, we did take a little bit of money off the table around the sort of 10th of March. Markets sort of bottomed out around the 23rd. Around mid-April, we did some further changes. So within the portfolios, in the direct equity component, we didn't necessarily add to risk as much, but we did change some of the stocks within the portfolio by selling sort of stocks that maybe hadn't fallen by much. They held up pretty well during the crisis, and rotating into some stocks that were good quality businesses at reasonable valuations. And then we might have trimmed a few stocks which we thought actually these may take a little while to recover. Then the other biggest change where we added to the portfolio was in a segment of the market called high yield bonds. So I'll explain what high yield bonds are. So if you think about fixed interest, you can invest in probably the most safest fixed interest asset being government bonds. So, you know, bonds issued by the Australian government or the US government. And they tend to be very low yielding now, sort of sub 1%. But they're perceived to be the safest because governments can always tax more, issue more debt, etc., print money to pay off the debt. So they're always considered money good to some degree, unless you invested in emerging market bonds, but that's different. So, you know, developed, stable countries like Australia, US are always seen as to be the safest fixed interest asset, but you get a lower return for that. Then you go into investment grade credit. So these might be blue chip companies who need to borrow money, and they can do it at reasonably low interest rates because they're perceived as good credit quality. And then you go into what are called high yield or sub-investment grade companies. And these might not be small companies per se. They're usually quite large companies, but they might not have the highest credit rating. That might be either because they already have a little bit too much debt, or you know, their business model is highly cyclical, or you know, it's not a bit as big a blue chip company as some others. So, you know, these are riskier bonds, I guess, but at certain points in the cycle, it does make sense to make an investment in these. And what I've plotted here is the historical yield. So this is the interest rate you get on those bonds when you invest. And what tends to happen is during a crisis, these bonds sell off. So, you know, if a bond trades at $100, what tends to happen is people say, well, actually, I just want my money. I'm going to sell it and I'll take 70 cents in the dollar. So the bond price falls, and what that means is the yield pushes up. And then there's also a push up in yield because people expect some of these bonds might fail. So, you might not get your money back. So default rates increase. And so during the GFC, the yields went from sub sort of, 3% all the way up to sort of 16, 17%. So this is the spread above government bonds. So you were earning 16% above government bonds. Now, what would tend to happen at that point would be there'll be default. So about 10% of the bonds would default, and then you get the money that's left over plus the interest. So then once that interest, what this chart's kind of inverted. So what it means when the yield goes down, it means the bond price is going back up. So you're buying a bond at 90 cents or 80 cents in the dollar, and then eventually people realize, actually, this company is going to pay its money back. So you're going to get $100 back, and the bond prices go back up. So we've kind of avoided this stuff pretty much for the last 5 to 6 years because there was never really attractive buying opportunity. But during the crisis, it did pop up. They spiked to about 10 to 12%, but it really only lasted a few days there. We managed to buy in at around this level. And since then, the yield's gone down, which is basically meaning the bond price is going up. Now, why would you invest in this, even if you think some of those companies might fail? Well, think of it this way. Let's say you lent 100 companies $100, and they're giving you a 8% yield. Even if 10% of them fail, you're going to have $90 left, but you're going to get $8 in interest. So that kind of offsets some of the fall in those defaults. And then going forward, you've still got 90% of those companies that are left there paying you 8% yield per annum. So in risk-adjusted terms, it's still, even if you assume there's a default potentially in there, or a percentage of them default, that's expected. That you don't go into high yield bonds expecting that they're all going to survive. It's in the mechanism, but you get rewarded for taking on that risk. And given that they've been yielding sub 4%, almost as low as 3% in some cases, if you go back to sort of early 2018, we thought a sort of 9 to 10% yield was an attractive enough point to which to enter. And so far that's been proven right. So, there could be a little bit more volatility to come from these, but on a long-term hold for the next 3 to 5 year basis, we're comfortable with that level of risk in the portfolio. And, this is a way in terms of adding a little bit of risk into the portfolio without necessarily having to lump it all into equities, which are much more volatile. So these tend to be less volatile than equity markets. So you're kind of getting, as an attractive return of sort of 8 to 9% over a long period of time for sort of less risk. Other areas where we're sort of starting to look are Australian micro caps and global small caps. So things have kind of rebounded a bit, but a lot of it has been driven by some of the larger US tech companies in the US. So when we're looking around, there is actually still opportunities in areas such as micro caps, global small mid caps, and then other areas such as value or Asian value or emerging consumer. So those are the areas of research focus at the moment, and where we're sort of starting to introduce or increase allocations within the portfolio. And then the other area could be commodities, energy, which I touched on earlier. But, it might be a little bit more of a contrarian, smaller position if we did do it. But there already is probably some exposure in the portfolios to that through companies such as Woodside. So that's most of the presentation for the economic and market aspects of it. What I was just going to touch on here is that, taking all of this, what do you do with it? Obviously, the importance of why you've engaged an advisor is, making sure that you're looking at your long-term objectives, and, it's really about having a plan. So, really think about these and what the context means for you and your long-term objectives. And, ultimately the Integro is there to sort of help navigate those bumps in the road, guide you through what's happening, and keep you focused on the target, and not getting too hung up about swings in markets, either upside or either on the downside or the upside. It's like, how do we position your portfolios to ensure that they're meeting that target over the long term? And generally this theme is termed the value of advice. And there's been a few companies in the US, this is all US based studies, that have done how do you attribute what that value is? If investors were left to their own devices and succumb to the worst behavioral biases, by selling at the bottom and buying at the top, or mistiming things, or not having a long-term plan that they stick to. And based on studies which were done in the US, they basically say that behavioural gap adds up to about 2% per annum. Now, that's not to say every one of you listeners would necessarily do that, but that's just what the research has been done in the US has indicated. So, there is value that's probably not tangible to see, but, by having a plan in place, you're probably ahead of what most other people are doing. So, and we'll finish with a disclaimer there. So what we'll do now is I'm going to launch the poll again, and just want to see, so we had sort of 64 and 36%. Just want to see what, if any, changes we've had. So if you guys wouldn't mind answering the poll, and we can see how things have changed. Okay, so we've had a little bit of a shift more towards a U-shaped type recovery. I don't know if there's anyone else wanting to answer. So sort of interesting. Maybe I oversold it a bit. Anyway, so what we'll do is we'll end that poll there. Thank you for participating. Now, there is the ability to ask questions. Let me just find it on my screen here if anyone has. Let me find my controls. Okay, so anyone got any, if you've got any questions, you can ask it in the Q&A or wherever else it may be. So if not, then I'll hand off to Shane to finish up. And if you have any questions, be sure to send them through to any of the team and members of the team, and we'll get back to you.
Yeah, so thank you for that, Phil. I think it was really good. Give us a bit of insight with regards to what's happening in the markets, and also a behind the scenes look at what we've been doing within the portfolios. But if anyone has any questions or needs anything from the team at Integro, just give us a shout. Like I said earlier, we will send out the recording via our normal communications. But if you need anything else, let us know. Thank you very much for joining us, and thank you, Phil.
Thank you.